Hi everyone. In the most recent video, we talked about the smart hack what FII does to increase their portfolio returns. But we left with one interesting hack, but we committed that we give you the second hack. That's a part two, am I right? And what did we say in the first video? We said that if you already have a shares, what is that you can look after in the market, especially in the derivative markets, that the smart hands usually carefully look at those areas and they try to exploit any interesting arbitrage benefit they make out of it. And we gave you a fantastic demo on it. But if you want to know more about the part one video with respect to this area, you can actually go back to that particular video section to get it. But in this particular video, now we're going to talk about the second hack, what you can do to optimize your portfolio returns using derivative markets. Remember, again, just a quick summary. If you are planning to buy shares for a long term, and if you are looking for a stock selection criteria in terms of finding a good company or a bad company, this is not the video. For that, we already posted a good number of videos. But this is the video which will tell you that you made up a mind to buy a share, let's say TCS. Okay, you made up your mind to buy a share called TCS. No doubt TCS is a good company at this moment by looking at all their financial records. In fact, we are recommending this particular stocks to all of our clients. As a disclaimer, I'm making it very clear. But the point is, what are the smart way that we can buy TCS? That is what the point. When it comes to the previous video, we said, if you already own a TCS, what is that you can do to make some extra income? But this video gives you what is the smart way that you buy TCS at much cheaper price than the market price. Let me give you a quick demo by getting into it. As I told you that, let's say if you get into a website called nseindia.com, and there I'm taking a company called TCS. Again, a word of caution that this video may not tell you how to find a good company. But if you somehow got a good company, then how to buy them at much cheaper price. Okay, that's an idea behind it. Let's say I'm now taking a company called TCS, which is Tata Consultancy Services. As of 9 January 2023, the share price is 3,309, and which was up by 3% on that intraday note. Assume that today is your day to buy TCS. Okay, today is a day to buy TCS. And do remember, this hack is not for a small time investors or small ticket investors who are investing in for a very less amount. Even if you are investing 30,000, 40,000 rupees per month, you may not be considered to have this particular hack. But how Axis recommend these strategies? Because once you build a portfolio at a reasonable size, then we automatically understand that you become eligible for that area, because following a derivative, okay, that section needs, there is something called lot size, and anyway that become applicable only if you have a sizable portfolio. Having said this, it's good to learn anyway, have a patience to have the whole idea. But whenever you become eligible to do that, whenever you get that whole big portfolio, look for these opportunities to make some extra income out of market. Look at it, how we can do. The share price is 3,309. And if you get into a derivative sections, okay, if you get into a derivative sections, and I'm actually taking the section called option chain. Okay, this option chain belongs to 25th Jan 2023 and belongs to TCS. And if you look at the 3,200 put option price, okay, which is trading at 29 rupees. The point is, for the rest of the world to buy TCS, it is available at 3,300. Okay. But if you look at the put option, 3,200 put option, it is also available at 29 rupees. Do you know what happens when you buy put options? By buying a put options, you are getting a right to sell. Assume that you are the person who's buying the put option, and I am the person who's selling the put option. And I am selling 3,200 put option, and you are buying 3,200 put option from Murugan. So what did we do? We did trade a put option striking 3,200. So this month on the expiry date, if you wish to sell TCS, because you got a put option, right? So if you wish to sell TCS, you can sell that particular TCS to Murugan, and Murugan will certainly take it because I'm obligated to do it. But the point is, I get it for 3,200 because that is the strike price. You got it from me. So what? By selling that particular put option, today to you, I'm getting the premium of 29 rupees, which is currently available. Instead of buying TCS at 3,300, I'm preparing to buy TCS at the rate of 3,200. So now two things can happen. TCS can skyrocket from their current level. Nothing wrong, because I've got my return on investment of close to 1%. Because am I right? Like, I've invested my money. Like, I've blocked. Ideally, if I have a TCS, I would have made my money. But on the whole, even if I'm getting a 1% returns on a monthly basis without even investing much of money, that's a wonderful point. Am I right? But remember, don't consider only future margin, because a lot more you have to think, because as an investor, you should be conscious about your risk. Don't get curious to know about, okay, there's a free income we can make out of it. Understand the risk is very important. So that's where the professionals come into the picture. So if you want to know more detail and professional guidance, do consider us and we can certainly help you out. But from a knowledge perspective, remember, by selling 2200 put option, I am now prepared to get those shares at 3200, provided if a price crashes below 3200. But nothing wrong. Instead of buying at 3300, I may be prepared to buy at 3200. Do you know who follows this particular strategy? This is one of the Warren Buffett's favorite strategies. So this is not a Murugan's thought to impress you. The point is, these things are universally there, but I'm just presenting you. So Warren Buffett is as a legendary investor who got a very clear idea. Once he buys a share, he wants to hold it forever. That's a kind of mindset he. So by any chance, instead of buying at 3,300, if I get the shares at 3,200, why not? And by any chance, if I'm not getting it, I don't mind as long as I get that 1% or 2% returns. But choosing the strike price needs a lot of professional experts, and that is where the derivative market experts can provide you a best support, and that is where Axis plays a crucial role. So the point is, if you go to 3,200 and if you sell that particular put options for 29 rupees, you are getting that particular shares at 3% lower. Am I right? And if you continuously do this particular exercise, sometime the cost of acquisition of TCS may be way cheaper. And if you want to be even more aggressive, you can even go for 3,150. And if you get it for a month beginning, you end up getting at much smarter price. So let's say, what is another hack you can do? This strategy is very good if you see the market is settled, neutral, or market is slightly bearish or slightly bullish. This strategy is extremely good in terms of acquiring the companies. And if you go to the February contracts, and the February contracts may not be that liquid, it's too early to get into the February contracts. But if you look at the February contracts, 3,100, which is close to 6% lower from the current level, is still available for 1% premium in a way that is very interesting. So these are all the way by which you are not committing your full money, but you are still getting some income out of it.